Friends, this is Hatim Rampurawala, and in this video we will revise test your knowledge of chapter number 6, that is decision making of CA final costing. In the earlier video we had discussed all the illustrations except the last one, and in this video we will begin with the test your knowledge. There are 6 questions in all, which all are basically a simple question, so we'll quickly go through. Let's start. Decision making. First, S manages a school canteen approximately 1600 students at Noida. The current cash payment system requires 3 clerks paid 90 paid 90 per hour, employed for about 4 hours a day. So they are employed for 4 hours. The canteen operator approximate for 240 days. Okay, so they are paid 90 per hour and 4 hours per day into 240 for the year. So it amounts to 86,400 for the entire year to one employee. Then S canteen is considering a wireless cash management system, WCMS, where the student could just swipe an ID card for the payment. This system would cost 1,25,000 to set up and 36,000 per year to operate. Okay, S believes that he could manage with one clerk if he were to implement this system. So after implementing this, it will be only requiring one clerk. So currently there are 3 clerks in all who are being paid. So for one clerk we are paying 86,400. So for 3 clerk it will be 259,200. And after implementation of software we will be incurring a cost of 125 plus 36,000 per year, and cost of one clerk we will incur. Require advice as limited on the choice of the plan, assuming the working life of the WMS as 5 years. Ignore the time value of money, so we don't have to do the present value. So in the first case it will be the 3 employee cost is amounting to 259,200 multiplied by 5 year, that is 12,96,000. And in the second situation we will be incurring a cost of 1,25,000 at the beginning, then 36,000 every year, so multiplied by 5, then memory plus, and then 90 rupees per clerk. So for 1 year it is amounting to 86,400. So for 5 year it will be 4,32,000. So it is amounting to 7,37,000. So in first it is amounting to approx 12 lakh cost, and after implementation of software it is 7,37,000. So we will go through the answer. Solution. For each day S spend 360 per clerk, that is 90 into 4, 90 rupees the plus into 4, so per day it is 360 rupees per clerk. Therefore S spend 1080 per day to an employee for 3 clerk. Annually it will spend 1080 into 240, that is 259,200. Over the 5 years an outlay will be 12,96,000. If the WCMS is implemented, the initial cost is 1,25,000. If we add the annual cost of 36,000, the total cost over the period of the 5 year will amount to 3,05,000, that is 36,000 into 5 plus 1,25,000. Since one clerk will be needed as well, S Limited has to incur 4,32,000 for a period of for 5 years to pay the clerk, that is 4,32,000. How it came is 90 into 4 multiplied by 1 clerk multiplied by 240, and for 5 years. Therefore the total cost of the second option after implementation of WCMS is 7,37,000, as I said while discussing the question. So accordingly there is a cost saving of 5,59,000 from WCMS implementation. Relevant financial and non-financial consideration that we need to take into consideration while before implementation. The WCMS may be a lot more efficient but more rigid. It will be efficient but it will be rigid, as in, for instance, if an for instance, if a student forgets an ID card, so he can't swipe, for instance, when if and he has to pay a penalty or a late fees or see, for instance, if what if the student forgets to bring his or her ID card, or the transaction or if there is a transaction failure, because it is an ITA system, or if it is a transaction failure due to the connectivity issue, or may not having enough cash to pay, or automated system may be less able to handle this situation, so it will be less able to handle this situation. Having clerk may add an aspect of flexibility and a human aspect that is hard to quantify. Okay, conclusion: obviously WCMS option is more cost effective than for S Limited, because there is a saving of 5 lakh, but but a non-financial factor should also be taken into consideration before before the decision making. Second question, Alia uh, Ayla, sorry, Ayla, Ayla, Ayla runs a planetarium station in New Delhi, India. The strength of the station lie in its live interaction and the program for the visitor. Okay, it is a planetarium in New Delhi. Its strength lie in its live interaction and the program. Then students and amateur astronomers. The station is always active with the program for school and colleges student, and for the amateur astronauts. One of the station key attraction is the big screen IMAX theater. IMAX is so what is the attraction over there is big screen IMAX theater. IMAX theater is one of the is a 70 motion picture film format which shows an image for image of the far greater size and the resolution than the traditional film system. The IMAX cinema projection standard were developed in Canada in the late 1960. Unlike a traditional unlike the traditional projectors, the film is running horizontally, so that the image wide is greater than the width of the film. Okay, this is just a normal basic data. So basically it has an IMAX theater in this planetarium. Then the average IMAX show at a station attracts 120 visitors, 50 children, 70 adults, at ticket price of 160 for the children and 200 for adults. Ayla we will say as A Limited, actually A only. So let it be Ayla estimates that the running cost per IMAX show is 10,000. In addition to the fixed cost of 10,500 are allocated to each show based on the annual estimate of the number of the IMAX shows. So 7,500 is the running cost for each show, and what we can say, Ayla's running cost is 10,000 per IMAX show, and it is attracting approx 120 visitors, that is 50 children and 70 adults, of which it is the IMAX is charging 160 for the children and 200 for adults. The Hobart school has approached Ayla about scheduling an extra. Actually it should be Alia. I'm not getting why it is written Ayla. About scheduling an extra show for its class 8 students. 100 students and 5 teachers are expected. 100 students and 5 teachers are expected to join the special show on the planets and the solar system. The feature that is currently showing, the school has asked the Ayla for the price quotation. The special show will take place at 8:30 am when the IMAX is not usually open, so it will not affect the running business. Only it will incur fixed costs of 750 are allocated to each show based on the annual estimate number of the show. So fixed cost won't be charged. Over in this only we will incur a cost of this 10,000. An estimate cost that running cost of per IMAX show is 10,000. This cost is the only cost which that is the school will be incurring. That is actually IMAX theater would be incurring. Okay, recommend the minimum amount that the Ayla should charge. So in last sentence they are given it is taken place on 8:30 am when the IMAX is not usually open, so it is not affecting its normal sales, so there isn't any contribution loss as such. What they have said for recommendation is recommend the minimum amount that the ILA should charge. So minimum amount we have to recommend. The incremental cost associated with the IMAX show per IMAX show appears to be 10,000. So incremental cost is 10,000. That is the cost of the running this show. The allocated fixed cost per show is not uh, sorry. For the cost of running the show, the allocated fixed cost per show is not relevant. The fixed cost per show is not relevant. That 7,500 will be not be relevant, but only 10,000 will be relevant, which is the running cost. Not relevant because fixed cost will not be relevant because the total amount of the fixed cost for the year will not change as a result of the special show. These stated ticket price are not relevant because the show will take place at 8:30 am when the IMAX is not usually open. Thus the student will not be displaying any regular visitors, will not be displacing any regular visitor. It is not affecting its normal sales. Based on the financial data provided, the minimum price quoted appears to be, so based on the financial data, minimum price quoted appears to be 10,000. ILA should consider the following factors. Does the station have the souvenir shop or the cafeteria? If so much students are likely to buy the food and the souvenir items, thereby increasing the station contribution. In turn, it would reduce in the minimum price quote. So currently the minimum price quote is from the financial angle we can see it is only 10,000, but if there is any food or beverages shops or the souvenir shop, so the contribution from them will help to reduce the contribution of this 10,000. Then it will help to reduce the minimum price quote. What is the impact of the future event? After seeing this show, many students may return with their parents, thereby increasing the future revenue. So it will also be benefited that many students may return with their parents, thereby increasing the future revenue in future. Then after are the cost linked with the special showing that are not included in the 10,000 variable cost number. So what they stated, are the cost linked with the special showing that are not included in the 10,000 variable cost number. Okay, for example, will the station have to pay an overtime premium? ILA should also consider the educational mission of the planetarium station. Such a show directly contribute to its mission. Since this education mission of the planetarium station will contribute to the mission station and hopefully the betterment of the student, the special show may be excellent way to expose some of the student to the earth science. So it will also help some of the student in pursuing earth science. These students may have never gone through the planetarium if it were not for the school excursions exertions. If it was not for the school, because okay, then overall the best price is charged is unclear. Because of non-availability of this data, we can say per se, this 3 point which we had seen. So overall the best price charge is unclear and requires some judgment, as ILA needs to balance an array of the financial and non-financial factors. So based on the financial and non-financial factor, ILA will basically go through the whether what should be the minimum price charged. Wait a second. Okay. So we'll continue with question number 3. Color paint is the manufacturer of the industrial dye. It has received an order for 200 kg of the powder dye that needs to be customized to certain specification. The job would require the following material A, B, C and D. The total unit required is 2000, 3000, 2500. Unit already in inventory is 0, 1200, 1400 and 500. Book value, realizable value and replacement value. Okay, material B is used regularly. So even okay, first we'll read is regularly in the production of all the types of dye that color paints produces. Therefore, any stock used towards this towards uh, towards this job order would need to be replaced to meet the other production demand. So any stock would need toward this job, so it is, if it is regularly used, it will be treated as there isn't any stock and we have to buy directly from the outside market. That is, we will incur a we will charge at replacement cost, then we will incur replacement cost. The inventory of the material C and D are from stock that was purchased in excess. Wait a second. Second, inventory of the material C and D are from the stock that are purchased in excess previously. So these are the stocks which are purchased in excess. Material C has no other use than for this special order. So inventory of the C which is lying is 1400. Out of, we are required 200 units of C, and currently it is available 1400, which has no used. So what we will do is, we will multiply 1400 into a realizable value of 9, and the remaining 600 will be multiplied by the replacement, because we had to purchase the additional 600. And for D, what they have given, D can be used as a substitute for 700 units of material Z. It can be used for the substitute of 700 for Z, which is currently cost at 11 per unit. So 700 into, what we will do is 700 into 11, that is 7700, or and as it was in excess and it is already available in unit, the company do not have any inventory of Z currently. Okay, so material D can be used as substitute for Z. Total required is 500 unit. The quantity available, quantity already in the stock is 500. So this will be multiplied by the realizable value, that is 12. So 500 into 12, that is 66,000 or 7,700, whichever is higher. We will quickly see this solution. Actually, for just C, I need to see. Okay, it is 12. Perfect. So we had discussed, we'll just see, go through the solution part. Required, analyze the relevant cost of the material while deciding whether to accept or whether to accept the order or not. Analyze the relevant cost of the material. So we have to find the cost of the material while deciding whether to accept the order or not to accept the order. So for each material we had to discuss. So the solution: material A, the requirement of 2000 unit of the material A has been purchased in entirely, since there has been no stock, no unit in stock. Therefore the relevant cost will be the replacement cost, that is 8 per unit. See, there isn't any cost, so the replacement cost 8. So 2000 into 8 directly we had done, which is 2000 in 8 unit for 2000, it is 16,000. 2000 into 8. Material B, as we had discussed, it is a regular stock. We will directly multiply this with the replacement cost, even though the units are available in stock. This we will multiply by 10. So 3000 into 10, it will be 30,000. See, there is a requirement of 3000 units of material B, of which 1200 units are in stock. The material B are used regularly in the production of all the types of the dyes. In the 1200 units in stock are 1200 units in the stocks are used. They need to be replenished, that is replaced in order to meet the production demand of the other dyes. In addition, for the special order, additional 1800 of the unit of the B is required to be procured from the market. Therefore 3000 units of the material B has to be procured if the special order is undertaken. The relevant cost for the replacement will be 10 per unit, which is 3000 unit is for 3000 unit, which will amount to 30,000. So as I said, the explanation, that if if a material is a regular material, so we had to directly multiply the quantity required with the replacement cost. Then for C, there is a requirement of 2000 units of material C, of which 1400 are in stock. The balance 600 have to be procured from the at the replacement price, that is market price per unit, which could be 8400. Material C has no other use, so if the special order is not undertaken, the stock of 1400 can be sold at 9 per unit. See, 1400 will be multiplied by 9, as I said, a realizable value, and the remaining 600 will be multiplied by 14, the replacement cost. So the opportunity cost of the undertaking this order is 12,600. Therefore the relevant cost of the material C is procurement cost of 600 unit plus the opportunity cost of not disposing the current stock of 600, current stock of 1400, which would be, so in short what we will do is 1400 multiplied by 9 is 1400 multiplied by 9 and 600 multiplied by 14, that will amount to 21,000. And we'll move on to material D. The entire requirement of 500 units of material D is in stock. If the special order is not accepted, Color Paints has two options: sell the excess material at 12 or use it as a substitute for Z, which would be otherwise needed to be produced. So the realizable value of the material D, if it has been sold, so it will be 5000 into 12, the realizable value. And second option, the material D can be used as a substitute for 700 units of Z. 700 units of Z. Since there is no stock of material Z currently, if the special order is accepted, the entire quantity would have to be procured at 11 per unit. That is the Z's purchase price. This would cost the company 7,700, that is 700 into 11. Both the option 1 and 2 represent the opportunity cost. If the special order is accepted, the relevant cost for the material D, if the special order is accepted, would be higher of either of these two opportunity costs. So higher of 6,000 or 7,700. The higher of the opportunity cost of the procuring the material Z from the market at 7,500. Therefore the relevant cost for the material D is 7,700. Therefore the relevant cost for accepting the special order, so for accepting the special order, we will incur a cost of the relevant cost for the material A, B, C and D, which will work out to, by adding all the cost which we have calculated in the above parts, amounting to total of 74,700. And we are done with illustration 3. It was a very simple question. Then illustration 4, diesel is engaged in the manufacturing. This is also a basic question. Diesel is engaged in manufacturing many chemical products. It is using many chemicals, some of which are fast moving, some are slow moving, and few are in non-moving category. The firm has a stock of 10 unit. So it is having non-moving, slow moving, all goods. The firm has a stock of 10 units of 10 units of one non-moving toxic chemical. Its book value is 2400. Realizable value is 3,500. So book value is 2,400, realizable value is 3,500, and replacement cost is 4,200. Okay, the firm has a stock of 10 units. One of the customer of the firm asks to supply 10 units of the product which need all the 10 units of non-moving chemical as an input. The other cost associated with the production of the product are, so which cost we will use? We will not use book value first of all, so either replacement or realizable value. So we will use realizable value, because we are not purchasing, we have this 10 units in our hand and we are using this 10 units, so we will be using realizable value as our cost for the 10 unit, which is 3,500. Now the other costs are allocated overhead expenses of 1,600. Okay, sorry, we'll continue. Allocated overhead expenses is 1,600, so it is allocated cost basically, so this we will ignore basically for calculation purpose. Then out of pocket expenses is 50 per unit, this will be considered. The labor cost of 40 per hour for each unit 2 hours are required. Okay, the other material cost is 80. The hours the labor force require for the production of the what we can say, the production of product which are deployed, the production of the product which are deployed from the among the permanent employee of the firm. So these labor force are deployed from the permanent employee force, so their pay, that is the labor cost of 40,000 will become irrelevant because they would have already been paid. So this is not for some additional product which they are incurring the cost. This temporary deployment will not lead to any loss of the contribution, and it is not leading to any loss also, so this cost won't be considered the labor cost. So recommend the minimum unit price to be charged to the customer without any loss to the firm. So what would be the minimum price charge? So what we will consider, 60 we will not consider, 50 we will consider, 40 we will not consider, 80 we will consider. So 50 plus 80 plus over here 3,500 units of 10 units. So 3,500 divided by 10, so 350 would be the cost of the material for 1 unit. So 350 plus 50 plus 80, likewise it will be amounting to approx, see we will see the answer. Diesel Limited has the opportunity to utilize 10 units of the non-moving chemical as an input to produce 10 units of the produce demanded by one of its customer. The minimum price to be charged to the customer would be 350, that is cost of material. Realizable value 3,500 divided by 10 units of the chemical. Out of the pocket expenses 50, other material cost is 80, so the minimum price to be charged is 480. Therefore the minimum price charged that can be charged to the customer without incurring any loss is 480 per unit of the product, as explained below. In point 2, allocated overheads, expenses and the labor cost are sunk costs that can be ignored while calculating. So labor costs are the sunk costs. So actually the minimum price is 480 per unit of the product, as explained in point 2 below. Point 2 basically we will analyze how they have derived for each and why they have considered the cost and why they have not considered the other cost as well. In point 2, allocated overheads, expenses and the labor. So allocated we had ignored, the labor cost we had ignored, are the sunk costs that are ignored while calculating the minimum price charged. As I said, labor cost will be ignored because it is the company is using the labor from the another department, so it will not add any cost over here. And allocated overhead cost is the what we can say, absorption cost basically, so that will also be excluded. We will see the reasoning in part 2. What they have asked in part 2 is analyze with reason for the inclusion and exclusion of each of the cost associated with the production of the product. Okay, inclusion and exclusion for each of the from the beginning itself. Analysis, first cost of the material analysis, relevance and hence hence at the realizable value. Diesel has 10 units of the non-moving chemical input that has a book value of 2,400, realizable value of 3,500 and a replacement cost of 4,200. Realizable value of 3,500 would be a salvage value of the chemical that it had been sold by the Diesel Limited instead of using it to meet the current order. This represent an opportunity cost for the firm, and hence this represent an opportunity cost that since it is not selling, it is a cost to the company. This represent an opportunity cost to the firm and hence included while pricing the product. Book value would represent the cost at which the inventory has been recorded in the books. Book value is just the book, the value on which is recorded in the books. A sunk cost that can be ignored, that is it is basically sunk cost we have to ignore. Replacement cost of 4,200 would be the current market price to procure 10 units. This would be relevant only where the inventory has been replenished, that is replaced after use. This chemical is from a non-moving category. That means that it is not used regularly. So if that material would be regularly used, so we would have considered the replacement cost, and since it is non-moving, that is replaceable, what we can say, not replaceable after use, not regularly used in the production process, hence we had considered realizable value, and hence need not be replenished after use. Therefore the replacement cost is ignored for the pricing. So replacement cost is ignored for the pricing because of this reasoning. Then book value cost 2400, that is also sunk cost, we have excluded. So the cost will be 3500 for 10. So for 1 unit it will be 350. Second part, labor cost, not relevant and hence excluded from the pricing. It is given in the problem that this order would be met by the permanent employee of the firm. The permanent employee cost is the fixed cost that the diesel would incur irrespective whether this order is procured or not. No additional labor is being employed to meet this order. No additional labor is employed to meet this order. Therefore since no additional labor is employed, the existing employed labor are only used. Therefore this cost is a sunk cost and hence excluded from the pricing. Third, C, that is allocated overhead expenses. This expenses has been incurred at another cost center. Typically example would be office and administration cost. Such a cost are fixed in nature, that would be ignored. So the allocated cost are fixed in nature and that are ignored. Basically such a cost are fixed in nature and would be ignored irrespective of whether this order is procured or not. Therefore this cost is sunk cost. Excluded from the pricing. Okay, so this cost is basically the sunk cost, allocated cost, and it is excluded from the pricing. Why it is considered as sunk? That these expenses have to be incurred at another cost center. Typically for example would be the office and administration cost. Such a cost are fixed in nature and that would be incurred irrespective whether the order is procured or not. So this cost will be incurred whether the order will be procured or not. So it will be considered. Therefore this cost is sunk cost, excluded from pricing. Then out of pocket expenses, this cost are the expenses that are incurred to meet the production requirement of the order. So these are incurred for meeting the production requirement. These are the additional variable expenses that need to be included in the pricing. Okay, these are the actually variable costs that need to be included, and so we have included also, and other material cost also we had included. These are the expenses that are incurred to meet the production requirement of this order. These are the additional variable expenses that needs to be included in the pricing. Advise on pricing policy. Under the perfect competition condition, diesel can have no pricing policy in its own. Here seller are price taker. Wait a second. These are the expenses that are incurred to meet the production requirement of the order. These are the additional variable expenses that needs to be included in the prices. We'll continue with the third part of the question. What they have asked is advice on the pricing policy to be followed by the diesel in the perfect competition. So what would be the pricing policy they would be following? Pricing policy under the perfect competition, diesel limited can have no pricing policy of its own because it is perfect competition. They have to follow because the supplier are the price taker in the perfect competition. Here the seller are the price taker. It cannot increase its price beyond its current market price. The firm can only decide on the quality to sell and continue the product as long as the marginal cost is recovered. When the marginal cost exceeds the selling price, the firm start incurring the loss. Since diesel limited cannot control the cost, cannot control the selling price, individually in the market, it can adopt the going rate pricing method. Here it can help its selling price at the average. If so what they are given is, since the diesel cannot control the selling price because they are the price taker in the market, it cannot adopt the going rate pricing method. Here it can keep its selling price at an average level charged by the industry. So what has been charged by the industry, they can keep that price only. This would yield a fair return to the firm. The average selling price would help the firm attract a higher market share in the competitive condition. We'll move on to fifth question. Fifth one is also basically a much simpler question. Question number 5th. Golden Pacific Airline Limited operate its services under the brand Golden Pacific. The Golden Pacific route network span prominent business metropolis as well as key leisure destination across the Indian subcontinent. Golden Pacific has a low rate carrier launched with the objective of commodizing its air travel offer airline seats at the marginal premium to the train fare across India. Okay. They have given that profit of the Golden Pacific have been decreasing for the several years. In an effort to improve the company performance, the consideration is being given to the dropping several flights that appears to be profitable. The company statement for each income statement for each of the flight from the Delhi to Leh GP0222 is given below. So the cost statement, so the income statement basically is given below. The revenue which we are generating is 7,35,000 less variable cost 1,47,000 contribution. Then the other fixed cost, not fixed cost, basically fixed or semi-fixed cost, and then we have arrived at a net loss of 1,58,100. Okay. The following additional information is available about the flight GP022. The member of the flight crew paid fixed annual salary, whereas the flight assistant are paid by the flight. So member of the flights are paid fixed annual salary, and they are paid fixed annual salary, whereas the flight assistant are paid by the flights. So this fixed annual salary will be ignored. Where they are given fixed salary. So flight crew, this 1,70,000 will not be deducted. It will not be considered because it will be irrelevant as it is fixed cost. But for flight assistant, they had said that whereas the flight assistant are paid by the flights, so over here this 31,500 would be considered for deduction of the cost. Then basically we will not deduct any of the fixed cost. We have to only deduct the variable cost. The baggage loading and the flight preparation expenses is an allocation of the ground crew salary and the depreciation of the ground equipment. So baggage loading and the flight promotion and the depreciation of the aircraft, what they are given, baggage loading and flight promotion expenses is the allocation of the ground crew salary and the depreciation of the ground equipment. So that will be ignored, that is baggage loading and flight will not be deducted. Then one third of the liability of the insurance is special charge assessed against the flight JP022 because it is an opinion of the insurance company. The destination of the flight is a high risk area. Okay, so the liability, 1/3 of the liability is special charge, so 2/3 will not be deducted, only 1/3 will be deducted. So what we will do is 1,47,000 into 1/3, that amount we will deduct. Then the hangar parking fees is a substandard fees charged for aircrafts at all the airports, so hangar parking fees, this will also be ignored. Then if the flight GP22 is dropped, the Golden Pacific Airline has no authorization at present to replace it with another flight. Okay, so we are left with which all thing to analyze. If we see salary, 1,70,000 will not be considered for deduction, but 31,500 we will take for deduction. Then baggage will be ignored, this 63,000 will be ignored. Overnight cost of the overnight cost of the flight crew and assistant at the destination, 12,600, this will consider for the deduction. Then fuel for the aircraft, this we will deduct. Then depreciation for the aircraft, 49,000 based on the obsolescence, this we will not deduct basically. Then liability, 1/3 we will deduct. Flight promotion, they have said, what they have said for flight promotion, they haven't said anything, so we will deduct. Yeah, they haven't said anything. Then and hangar parking will be ignored. Required, using the data available, prepare the analysis showing what impact dropping flight GP22 would have on the airline profit. So excluding this fixed cost, what amount of contribution which we get is, we will calculate. See, first take on your calci 5,88,000 the contribution figure, deduct 31,500, we will ignore 1,70,000, then deduct 12,600, then deduct 2,38,000, then depreciation of the on the aircraft will be ignored. Liability, this we have to consider only 1/3, so that is 1,47,000, 1,47,000 into, sorry, divided by 3, this we will deduct 49,000. Flight promotion we will deduct, so we are getting a contribution of 2,28,900 profit, and initially we were getting a loss of 1,58,100. so we'll check whether first of all we are right, or whether we have done any mistake. No, we are correct basically, 2,28,900. so we'll go through this text once. This is also just an explanation of what we did in the calculation part. As per the statement given in the problem, flight GP22 incurs a net loss of 1,58,100. This is the net result of the revenue less cost. The revenue is entirely variable depending upon the passenger occupancy cost are both variable and fixed in nature. To analyze the impact of the dropping of the flight GP22, we need to compute the net gain that the Pacific Airline earns when it operates the flight based on the relevant costing principle. Net gain or loss earned from the flight operation less the variable cost of operation. So net gain is the gain earned from the flight operation less the variable cost of operation. The revenue earned in the ticket revenue, the revenue earned is the ticket revenue earned from the flight GP22 is the entirely variable. The variable cost of the flight operations are those expenses that are incurred only when the flight is operated. These include the variable expenses per passenger, salaries, flight assistant, overnight cost of the flight crew and assistant, fuel and for the aircraft, one-third portion of the flight. This all the cost we had considered for deduction, that is specifically related to the floor, and the flight promotion expenses. These are the expenses that will not be incurred if the flight is not operated, hence relevant for the decision making. So all the relevant costs we will consider for decision making. Other expenses like salary for the flight crew, hangar parking for the aircraft are fixed expenses that will be incurred even if the flight does not operate. Loading and flight preparation expenses is an allocated cost that allocated cost that can be continued to be incurred even if the flight GP22 does not operate. So the other this fixed cost, all fixed cost will be incurred even if the flight is not operated, so that it becomes irrelevant whether the flight is operated or not. Hence the costs are irrelevant for decision making. Cost that will continue to be incurred even if the flight GP22 does not operate. The depreciation on the aircraft and the liability insurance expense of two-third portion which is not related to the specific flight sector are sunk cost. These expenses have already been incurred and hence are relevant to the decision making. Therefore these fixed, allocated and the sunk expenses are ignored while analyzing the decision whether to continue the operation flight GP22 or not. So basically we will consider all the relevant cost and not the fixed cost. The same thing they are given in the theory also, and if we calculate it in a numeric, that is 5,88,000 minus the variable cost, all the relevant cost as I discussed in the question itself. So we are getting the net gain of 2,28,900. So the conclusion: if the Golden Pacific Airline Limited discontinues the flight GP22, profit will reduce by 2,28,900. Thus the statement showing the loss if the operation of 1,58,100 misleading for the decision making. So this statement that which is showing a loss of 1,58,000 is misleading for the decision making purpose because it accounts for the cost that are fixed and irrelevant. However, since the flight GP22 yield a net gain of 2,28,900, the flight operation should continue. So our decision will be the flight should be continued because it is gaining a positive contribution, that is of 2,28,000. Just because the irrelevant fixed costs are being deducted from this, we are getting it has been showing that a loss of 1,58,000, but that are not relevant for decision. So our profit net gain basically is 2,28,900. So we'll continue. So the flight operation should continue. And now the last question of this chapter, question number 6. This is also very nice question, as such a big question but not a difficult one. First, so we'll continue. About Aditya Group. Aditya Group was established in 1975. The manufacturer and 1975 manufactures and sell the electronic personal grooming and beauty product. The group has 200% subsidiary AUS and ANZ. AUS manufactures luxury product that caters to niche customer who prefer specialized personal grooming and beauty care. ANZ Limited caters to regular daily beauty and grooming requirement that are wide reach within the market. Factory of both the company are located within India. The product are sold to the wholesaler who supply this product to the retail market. This was just introductory, no information is useful in this. The Aditya Group purchases its raw material requirement from both the domestic and overseas market. Additionally, certain product manufactured from the AUS can be enhanced based on the product manufactured by ANZ. Therefore, as per the production requirement, AUZ Limited sources some product component from ANZ Limited. Aditya Group has centralized decision making setup, basic policy decision for the functions such as the production planning, sales and the client relationship, finance and human resources are handled at the group level. Individual unit AUS and ANZ concentrate on the manufacturing alone. Okay. So this all thing was basic and just an introductory part. About you are an assistant manager in the finance and accounts department of the Aditya Group, headed by the director finance, Miss LC. So director is Miss LC, and you assist and report to Miss Fiona, a manager of your department. Okay. So manager was Fiona and director is LC. Sometimes you also assist the director finance in analyzing the financial and non-financial information, drafting the report for the board preparation and the presentation and staff training. So So we provide this so we do this kind of work also, that is drafting report for the board meeting preparation and presentation and staff training for the assistant for the director finance. Okay. Business situation 1. Yesterday at 5:15 p.m. you got an email from Miss LC with CC to Miss Fiona, that Miss LC asked you to prepare a cost statement. So the director finance, that is Miss LC, asked you to prepare a cost statement for making a quotation to a new customer. The cost should be she should be informed, she has also informed you that the customer can also maintain a long-term business relationship with us. You have been requested to gather the information related to the specification from the sales manager for the product costing. Okay. Then at 5:25 we got an email that you have been called by Miss Fiona and provided with the product specification received from the sales manager, for which quotation has been quoted. Miss Fiona has requested you to gather the relevant information to prepare the cost statement. Due to the expected long-term business relationship with AUS Limited wants to have with the customer, the sales manager wants to quote the lowest price possible. Okay, so sales manager said that they have to quote a lowest price as possible to maintain a long-term relationship with the customer. AUS Limited currently has spare capacity that can be utilized to cater to the entire order. So they have a spare capacity as well to fulfill the needs, fulfill the entire order. Then therefore only the relevant cost for the AUS has to be considered to arrive at the quotes. Okay, after meeting with your reporting officer, so after meeting with your reporting officer, you mailed to the various concerned department and requested for the data. So after a conversation with Fiona, we had mailed to every department for collection of the data for preparing the cost sheet for quotation, for the purpose of the making quotation for the new customer. The following information has been obtained in relation to the contract. Today 10:05 a.m. you have got an email from the production manager it is been informed that 40 tons of the material DX would be required. This material is an regular use by AS and has a current purchase price of 380. So from now onwards the financial data, that is the numeric data, starts. So we have to understand that which all cost is relevant and which cost is not relevant. A simple question, but just a little lengthy, but then too it is not much lengthy also. It is manageable, quite well manageable. So what that said is that it informed that 40 tons of the material DX would be required for that order, and this material is in regular use by the, so if it is regular use, we will always use the replacement cost. Replacement cost is regularly used by the AUS and has the current purchase price of 380. Currently there are 5 tons in the inventory which cost 350 per ton. The resale value of the material in the inventory is 240. So resale value is 240. Currently 5 ton of inventory is in inventory which cost 350 per ton. So which we have 5 ton, it is costing 350. So that all is irrelevant, just we had to keep in mind that this 380 will be relevant, the current purchase cost for this 40 ton of the material. Further, so what we will do is 40 multiplied by 380, as simple as that. Then further, with regards to the component, it has been informed that it has been informed that 4000 component would be required. This could be bought externally for 15,000. So we have also been informed that we would be requiring 4000 component, of which if we buy externally, the price will be 15 each, and alternatively they could be supplied by ANZ. The variable cost of the component, if it were manufactured by the ANZ, would be 8. So if we purchase from the ANZ, it will be for 8. ANZ has sufficient capacity, to sufficient capacity to produce 2500 component without affecting its ability to satisfy its own external demand. So if we are giving the manufacturing to ANZ, so it has capacity only to the extent of 2500 without any contribution loss. So for additional 1500, what we will do is, see what the data they are given, 2500 component without affecting its ability to manufacture its ability without wait a second without where is the where without affecting its ability to satisfy its own external sales, external customer. However, in order to make an extra 1500 component required by the AUS, ANZ would have to forego. So for that 1500, ANZ would have to forego the external sales of 50,000, which has the contribution to the sales ratio is 40%. So contribution to sales is 40. So of 50,000, we will do the 40%. It will amount to 20,000, I think so. Yeah, it is 20,000. 50,000 multiply by 40% is 20,000. Okay, for that we have to sacrifice, we have to forego the 50,000 rupees sales, which is contributing 40%, what we can say it as a profit, actually contribution. If to have the uniformity in the quality of the component, it is assumed that the AUS would procure its entire requirement of AUS would procure entire requirement of 4,000 component, either externally or from ANZ. The transfer price policy for Aditya Group. So to have the uniformity in the quality of the component, it is assumed that AUS would procure its entire requirement of 4,000 component either externally or from the ANZ. The transfer pricing policy for the Aditya Group for the sales between the unit aim at goal congruence, the unit selling the goods would be allowed to charge any opportunity cost such as opportunity cost as on account of catering to the internal demand, while the purchasing should be ensure that the company is not at loss. So after this whole their discussion, we just need to focus over here with the cost part. So what will be the cost? Basically, for 1500, 2500, 2500, we will multiply by 8 per unit, which they can manufacture at 8, and for 1500 we are foregoing the 50,000 rupees sales, which is generating a contribution of 40%, so to 20,000. So what we will do, 2,500 multiply by 8 plus 20,000, that will be the cost of the material, cost of the component basically, not material. Then today 10:45 am you got an email from the personal manager. It has been informed that 2,000 high skilled labor would be required. So we in all need 2,000 high skilled labor. The grade of the labor required is currently paid 5 per hour. So the one which we pay for this grade is 5 per hour. Then highly skilled labor is in short supply and cannot be increased sufficiently in the short term. This labor is presently engaged in the demand for the product Z. So it is presently engaged in demand for product G, which requires 4 hours of highly skilled labor. The contribution from the sale of 1 unit of product L is I don't know why they have given first G and then L. It is differentiating. It should be actually same basically. The contribution from the sale of the product L is 24. Let it be. So consider it as the same product actually. So 24 divided by every 4 unit is what it was requiring. So 4 hours it was requiring. So 24 divided by 4, it will amount to 6 per hour. So we have 5 per hour cost plus 6 per hour, it is 11 per hour, which will be multiplied by 2,000 skill hours. So 11 into 2,000 is 22,000. Then supervisor, sorry, this paragraph, the machinery thing. Now what they have said is it should it has also, we are reading still question only. I thought I should clarify, else it will be a confusion. I am just going on discussing the answer as well, so it would be easy when you read out the answer, because it is not good, we can say, or best, we can say, to just read the question and then go and see the answer. It is better that I discuss it over here, the what would be the solution, and then we can see that how they have presented the answer. Okay, for material thing, it is done, component is done, labor is done. Now it has this is the this para is in relation to the machinery cost. It has also been informed that the contract would require a special machinery. The machine could be hired for 15,000 or it could be bought for 50,000. So it can be hired for 15,000 or 50,000 at the end of the contract. If the machine were bought, so if it is hired, so it will cost for 15,000. If it is bought, purchased, so it will cost 50,000 at the end of the contract. If the machinery were bought, it could be sold for 30,000. So we had bought for 50, sold for 30, we will cost 20,000 in that. So we will identify various alternatives and then select which is the lower cost. That alternative we will select. So for in this there are three alternatives. First is 15,000 cost, higher cost. Second cost is 50,000 minus 30,000, that is 20,000. And third alternatively it can be modified at a cost of 5,000, that is first we will purchase at 50 plus modify by incurring additional 5, which will amount to total cost of 55,000, and then used on the other contract instead of buying the another essential machinery that would be costing 45,000, and then for using this machinery for the other machinery which would be costing 45,000. Sorry. So basically this would be a saving of 45,000 rupees. So we are incurring cost of 55 and saving of 45. So it will be a cost of 10,000. So what all three costs we got? 15,000, 20,000 and 10,000. Lower of all, that is 10,000. That cost we will consider. Alternatively, it could be modified. Okay, this is done. The operating cost of the machinery are payable by AUS, whether it hires or buy the machinery. This cost would total to 12,000 in respect of the new contract. Supervisor, okay, the cost would be total to 12,000 in respect of the new contract. So this is an additional fixed cost basically. So this will also be forming part. It is not irrelevant, it is relevant basically. We can, if we see it, because it is incurred on the new product, then supervisor, the contract would be supervised by an existing manager who is paid an annual salary of 50,000. So it has been supervised by the manager who has been paid 50,000 and has sufficient capacity to carry out its supervision. So it has sufficient what we can say, capacity as well. So the manager would receive a bonus of 5,000 for the additional work. The earlier cost 50,000 is ignored because that we will pay only. There isn't any choice, and that is not incurred because of the additional this acceptance of the product, product or the deal. But this additional cost of 5,000, that we will consider as a relevant cost. Then the development time, 15 hours of the development time at a cost of 30,000 have already been worked. So it has already been worked. So this also forms an irrelevant cost in determining the resource requirement of the product. We'll move forward. Fixed overhead absorption rate. So this cost will also be irrelevant. We can if they are given fixed overhead cost, and if it relates to marginal cost decision making, whether we have to go with the expansion or go with the a proposal or not. In this case, in every sum you have to just basically ignore the allocated fixed cost or the fixed cost absorption rate, so that point will be ignored. Then the today at 11:15 p.m. Mrs. Fiona call you in her place and asked you the following. First, required part: calculate the relevant cost of the contract, the one which we had discussed for each, the component, the raw material, the labor, the supervisor, what would be for the depreciation, what would be for the allocated cost, what will be for the development time, what will be for the cost for the machinery, that will prepare in a tabular format. So calculate the relevant cost of the contract to the AUS. You must present your answer in the schedule that clearly shows the relevant cost value for each type of the item identified. So each type of an item identified in the sense material, component, what we can say, labor, machine, then development time, as such all the items, all the subhead identified above. You should also explain each relevant cost you have included in your schedule and why the values you have excluded are not relevant. So we have to give the reasoning also why we had included and why the costs which are excluded are not why the costs which are excluded are not relevant. First of all, ignore the taxation and the time value of money. So time value and taxation has been ignored, so that is the relaxation by ICAI. Then to the other basic things of as we had discussed for components, raw material, then labor is much simpler. You will go through the solution, you will get it easily. And if you would have revised this earlier as well, so this would be a what we can say, a sail through for you. I basically, for revision purpose, it should be as such that it consume at every revision we should be able to do it at a lesser time than we had invested in the previous revision. So our aim is to quickly revise. So we'll first of all go through we had read till okay. Explain each relevant cost value you have included in your schedule and why any values you have excluded, that also we had to state. Then ignore the taxation and time value. Okay, discuss two problems that you can arise as a result of the setting price using the, so we have to discuss the two problems that can arise as a result of setting the price using the relevant costing. So what problem specifically we can arise is the pricing problem we can arise. There could be a pricing problem, or so we will see that because that is a theory based. Basically the first sub part is solution based, and we had to give the reasoning also for inclusion and not inclusion of the respective cost, and the second is the problem that we will also discuss. Okay, then situation 2. Today at 5:26 p.m. a memo from the managing director of the group has been circulated to all the officers of the group, which stated that my objective of the forthcoming year is to reduce our quality cost in such as a primary activity in our value chain. The managing director is stating this all. The company is keen to build a reputation for the quality and give a 5-year guarantee with all of its product. So company is about that reputation for the quality. It should build a reputation for the quality and a 5-year guarantee for the all of its products sold. At 5:37 p.m. Mrs. Fiona called you in her place and asked the following. So the required part. So in earlier case there were two required part, and this is the third required part. Explain by giving the examples how each of the 4 types of the quality cost. So what are the quality costs? Basically prevention cost, appraisal cost, internal cost and external cost would be reduced. You should also explain in which primary activity one of your examples could occur in the, so in which primary activity. So they are referring here primary activity as Potter's value chain primary activity, inbound, operation, outbound, or marketing. So basically in prevention we can say operation activity would be related I am specifically referring to this answer, else it might be different for different one. Then in this they had relate the appraisal with the inbound logistic, then they had relate the internal cost with the process, again with the process, and the what we can say, or that is process in the sense operations, and the external failure they have linked to the after sales services. Okay, that we will see in the third part, but how to calculate the first part. So we will continue, we'll move on to the question. And okay, from here we have to see sixth solution. Wait a second. So we'll continue with the solution required part. So in first they are asked to calculate the relevant cost and then explain each and every cost value, that why we included and why we have not considered that as relevant. So we will move to other solution. First part, statement showing the relevant cost. Material dx, as we had said, as it is an regular use product, so we will consider replacement cost of 380. So 40 multiplied by 380, that is 200. Then component cost, for that, how this 52,000 came is, as we has discussed also. So we will go actually by the explanation, then we will see the figures, so it will be easy for you. See, explanation, material, or else I will speak out, then it will unnecessarily confuse you. So it is better I go with explanation, because at the end we will read this thing. So this will be done with reading also, and these solution parts, numeric can be also be explained with this explanation. Material dx is a regular use by AUX and must be replaced. Consequently, it is relevant. Its relevant value and its replacement cost, a historic cost, is not relevant because it is past cost, and the resale value is not relevant because the AUS is not going to sell it because of the material in regular use. So since it is regular use, so we had took the replacement cost. Then for material, note 2, AUS Limited would like to produce 4,000 components either from ANZ or externally from the market. At the current production level, ANZ seller has available capacity to accommodate the parts of the AUS Limited request to the extent of 2,500 component. So it has 2,500 component ANZ. At this point, ANZ would be operating it at its maximum capacity. So ANZ would be operating it at its maximum capacity to cater the remaining demand of 1,500 units from the AUS. ANZ has to forego external sales of 50,000 to its so it have to forego the external sales of 50,000 to its own customer, giving that the contribution to the sales ratio is 40%. Therefore, the ANZ has to forego the contribution of 20,000, that is 40% of 50,000, in order to cater to the AUS request. Fixed cost of the ANZ is irrelevant. The fixed cost is irrelevant since it would be incur irrespective of the AUS order to cater to or not. Okay, therefore in the spirit of the goal congruence, the transfer price that ANZ would charge to AUS would be the variable cost of 8 per unit and 20,000 towards the loss of the contribution. Therefore the transfer price will be 8 into 4,000 component. Sorry, I had while explaining the question, I said 2,500 into it, but actually it will be 4,000 into it, because that 8,000 also, for that 8,000 also we will incur the cost of 2,000 basically. Sorry, for 8,000 also, for the remaining 1,500 also we would be incurring the cost of 8 per unit, thereby incurring a contribution loss. If we are just using the 2,500, so there will not be any contribution loss. So actually we are consuming that additional 1,500 also. So total 4,000 into 8 is amounting to 32,000. And actually I did mistake while explaining I cover the question, but you would have got that 4,000 will be multiplied by 8 plus 20,000, that is 32,000 plus 20,000, that is 52,000 or 4,000 components for 52,000 for 4,000 components. Therefore the per component price charged would be 52,000 divided by 4,000, that is 13 per component. This is lower than the external market price of 15. Therefore in the interest of the goal congruence, the cheaper option is preferred. So if we calculate in all what was the per unit cost, so what we did it is 52,000 the total cost divided by 4,013, and we can procure the same thing from outside at 15. So it is better to go with this option than to to buy it at 15, because this is cheaper one. Therefore in the interest of the goal congruence and the cheaper option is preferred, AUS should focus its component from the A and Z for a total procurement cost of 52,000. Then skilled labor is in short supply and can only be obtained by reducing the production of the variable reducing the production and product G, resulting in a loss of the contribution of see third one we are reading of labor. Skilled labor is in the short supply and can only be obtained by reducing the production of the product G, resulting in the loss of the contribution of 2,400 given or 6 per hour of a skilled labor. Hence the relevant labor cost will be 6 contribution lost plus 5 labor hourly rate of the skilled labor, that is 11. That will be multiplied by 2,000, so it will amount to 22,000. See, they are given third direct labor, 11 into 2,000 is 22,000. Then that component also the cost was 52, so we had written over here 52. Then the special machinery cost, as I explained, 15,000, 20,000 and 10,000, accordingly 10,000 whichever is lower came. Then machine operating cost is 12,000, they had given directly in the question that it will incur. Then supervision cost, they have given the salary of the supervisor, that will be ignored because it has already been incurred, and it is not an additional cost for this project or for this offer, but they have given they are paying an additional bonus of 5,000 to the supervisor, so that this will amount to the cost of this new order. Then development time will be ignored because it had already been paid, and fixed overheads or general fixed overheads, because it is an absorption cost. So the total cost comes to 1,16,200, which they had asked that prepare the relevant cost statement. So this is the cost. So whichever explanation are left of us is this machinery thing. Fourth, see, I will read it. AUS Limited has the number of the option. First, the machinery which was hired, it would have been cost of 15,000, first option. Second, if the machinery would have been bought and then sold at the end of the work, it would have a net cost of 20,000, that is 50,000 minus 30,000. If the machine were bought and then modified to avoid the need to buy the other machine, it would have the net cost of 10,000, modification less 15,000, less 15,000 cost of the another machinery. Thus the most economic approach is to buy the machinery and then modify. Buy the machinery then modify. So buy machinery 50,000 plus modifying 5,000, and then to use it for another machinery less 4,000, 45,000 cost of the another machinery. Thus the economic approach is to buy the machinery and then modify it so that the relevant cost is 10,000. Okay. Then machine operating cost for the future cost are doing the work and therefore are relevant cost. So this is the relevant cost, machine operating cost. Then supervisor salary is irrelevant. As I said, salary will be irrelevant, but the bonus need to be included because it is dependent on the work, and that is relevant because it is dependent on the additional work. Basically the development time has already been incurred. It is past cost, and not relevant. It is past cost and it is not relevant. Basically, general overhead cost and other absorption cost are not relevant because they will be incurred whether the whether the work goes ahead or not. Because work goes ahead or not, that cost will be going to incur. Depreciation is also not relevant because it is not an accounting entry based on the historic purchase of the asset. It is not affected by the work being considered, so depreciation also won't be considered in the cost part. So we are done with this analysis also, that why we have included and why we have excluded certain of the some of the cost, or actually all cost. Then what second thing they have asked is, discuss the two problems that can arise as a result of the setting price using the relevant costing. Okay, so the two main problem are profit reporting. Okay, so profit reporting basically can be the problem, and the pricing of the future work. The two main issues arising in the pricing work based on the relevant cost is profit reporting and the pricing of the future work. With regards to the profit reporting, the decision as to whether to propose with the work will have been based on the issues of the relevant cost, but the routine reporting of the routine reporting of the profit from the work will be based on the company's normal accounting system. Hence this system will be based on the total cost. It is probable that the cost of the work reported be greater than the relevant cost. Cost of the work reported will be greater than the relevant cost. Consequently, the amount of the profit reported to have been made for this order will be lower than the expected and may even loss. This may cause the difficulties for the manager who accepted the work as an explanation will require the reasoning why there is such a difference in the profit. So there will be a reporting mismatch. So they have to give the reasoning to the manager if there is any difference. Then second, with regards to the pricing of the future work, the difficulty lies in increasing the price for the similar items for the same customer. So for increasing the price of the similar item for the same customer, once the price is set, customer tend to expect that any future item will be priced similarly. So if a product X has been priced at 100 rupees, for example, and if the similar product company produces Y as well, so the user expect that to be of 100 only. We cannot sell it for 150 or 200 even. Then we have to properly differentiate what is the difference from the earlier unit to this unit. But until and unless they are much similar, so customer won't be paying higher for the similar goods. Once the price is set, the customer tends to expect that any future item will be priced similarly. However, where a special price has been offered based on the relevant cost because of an existence of the spare capacity, the supplier would not be able to continue to price on the basis as it does not recover its long-term cost. So if on some order, if the supplier had given some discount based on the benefit which they would have derived, and on the next order they can't, so this may be the variance. So there may also be the difficulty created by this method of pricing, as other customers are being charged on the full cost basis, and if they were to discover that the lower profit were offered to the new customer, they would feel that their loyalty is being penalized. Okay, and if we are selling it to the new customer at a lower price, and if the earlier customer get to know that we are supplying to the new at a lower price, so the loyalty will be affected. That is, of the loyalty would be affected of the existing, that is the old customers will be basically be penalized.